In this video, guys, I'm going to look at stop loss options for a mean reversion trade. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. Alright, so this is a question or a comment actually on a video talking about where to put a stop loss or ideas or my thoughts. Doesn't necessarily mean it's right, but just ways and ideas to use a stop loss when you're trading mean reversion. Just for avoidance of doubt, guys, mean reversion, something like this. You've got a mean, whatever that may be. It could be a moving average, could be a fixed level, could be a VWAP. Could be something we perceive as the sort of average price, and as price moves away from it, we expect it to come back in towards it. Now, this is really how markets generally move. Even if they have an uptrend or a downtrend, they'll generally be mean reverting along their merry way, whichever way they're going. So timed right, a super powerful strategy. So how do we actually use stop losses when we're trading mean reversion type strategies? Because of course, the further away from the mean it goes, the better the trade, right? But of course, at some point, the markets won't mean revert, or the mean will move and we'll be in a trending environment. So if this breaks out now and carries on up to here, that mean is going to move. And yes, it might revert to the mean, but because the center point of the mean is moved, you're in trouble. So let's have a look. So the standard one you could use is a percentage of distance to the mean. So let's say, let's just call it 100 pips, right? Easy argument, 100 pips from the high to the mean. You could just use a percentage and say, hey, I'm going to use a fixed percentage of 50 pips because I'm trading mean reversion. I expect it to come back 100 pips. I'm already kind of trying to time my trade that I feel like it's at the upper end of the extension. So, okay, I will use a 50% stop, or I use a 20% stop, or I use a 100%. If you've got a strategy that's working well a lot of the time, then you can use a one-to-one. I know it's unheard of, like, oh, we should have more, but yes, in this circumstance, maybe you can. So a fixed percentage of distance to the mean. And a way of getting that number, you could look at your previous trades and go, okay, how good am I at getting that sweet spot? If I'm not so good and I'm a little bit early, that's going to have to be a little bit of a bigger number. If you're good at finding that sweet spot, then maybe you can have it a little bit tighter. So I'm always a big advocate of going back to your previous trades and looking to see how you've performed rather than the textbook way, or how the best way that you could possibly set it. Second thing, guys, is if the mean shifts against you too much. Now, this is something that's quite clever, really, and a little nuanced, and there's a little bit of adjustments and tweaks to make to this, but it works pretty well. So if you have a moving average, for example, it's an easiest one to use, and it's not always the traditional mean, but it's a good one for a kind of example purposes. If it now starts to kind of curl up too much, and again, this is very subjective and it depends on how you're going to trade it, but if the mean is moving too far against you, and again, you could use a percentage of the distance potentially, or however you want to judge it, but if it mean starts to move against you by too much, cut the trade, because that potentially means it's rotating from a mean reversion environment to a trending environment, and that's the last thing you want. So that's a really good way of using a stop and preventing yourself getting caught out from the transition from mean reversion to trending. And whatever that mean may be, of course, unless it's a static mean, like a fixed level, like the opening price or the high, or whatever it may be, of course you can't do that. But if it's a dynamic mean, that's a good way of kind of judging things. The other thing is a time-based stop. Mean reversion, guys, just like most trades really, if it's staying at that level for a long period of time, the mean is going to catch up with it anyway, because unless of course you've got a static mean, but you could say, hey, obviously depending on swing trading, day trading, listen, we've been here too long now, I don't like it. We've not seen the sellers perceiving this as value in the case of a move to the upside against the mean. We've not seen the supply coming in that I thought. I've given it enough time, I'm going to cut it. Now, of course, that's not a price stop, and you do well to add that to a price stop as well, but it's a good way of stopping yourself, no pun intended, being caught in a trade that is just not really working. Another one is hedge with another instrument. This is a little bit more complicated, but depending on what you're trading, if you're trading an instrument that, say, most of the time is correlated with another, let's say you're trading NASDAQ against the S&P 500, or let's say you're trading FTSE DAX, and there's some loose correlations there, but you get the idea. We're not talking about something completely uncorrelated. You could be trading one and shorting it, and it's kind of going against you. Rather than covering the trade, you can, if there is a laggard, i.e. let's say you're shorting the NASDAQ here and the S&P 500 slowly going up, you can then go long on the S&P 500, and that's going to It's still going to give you risk because you're still exposed to the differential between the two, of course. But if for some reason you feel that the NASDAQ specifically is overstretched, you've traded that, it's not working, rather than dumping it and coming out and taking the loss, you could, as long as it's in with your trading plan, consider buying something that's got a reasonable correlation, like the S&P 500 for example, so that it mitigates some of the risk. But if it is true the NASDAQ is too stretched and it's going to mean revert, that's the one that's probably going to give you the profit, and hopefully S&P 500 will kind of catch up. Maybe you'll make from both legs. So something to consider, but a little bit more advanced, that one. The other one is a fixed stop. So this is a little bit of a tricky one, because a fixed stop is tricky to sometimes gauge, and I'm always a big fan that having a scaling strategy in, but very, very strict. You're not just adding blindly, because that's when you get caught out massively. But a scaling strategy is pretty good. The other way of doing it is to use a trigger to enter. That's when you can use a fixed stop. So what I mean by this, so using some kind of specific trigger to enter the trade. So even, let's say you consider this area to be a mean reversion entry to the long side, a mean reversion entry to the short side. You don't necessarily dive in short when it gets here. You kind of say, okay, well, it's in my zone. Now I'm going to look for a trigger to get in. And that could be, maybe that's a lower high, maybe that's a double top, maybe that's some sort of candlestick pattern. But in your zone of interest, i.e. you think it's a mean extended move, it's a mean reversion trade, then use a trigger, because that allows you to use a stop that's relevant to this trigger, which of course would be a stop above the high. Because if you're trading a pure trigger or a lower high, for example, let's say on a short-term time frame you're trading that short there, your obvious stop is going to be above the high. So you can use the trigger stop in with the mean reversion type strategy, and that's quite effective and quite powerful to do that. And as a kind of similar thing I talk about in my program, the filters and triggers. Now this is just mean reversion and one example of it, but having a filter that allows you to just get rid of all the noise and stop you over trading stuff and really narrow down on what you want. But that doesn't mean you take the trade. You still need the trigger to pull the trigger to get into the trade. So you have one, yes, it brings it to your attention. In this mean reversion example, could be, okay, I'm here, this is my level where I'm interested in shorting it, but unless I get the trigger, I won't take it. So if this thing carries on and rips up and up and up, fine, you're out of the trade. You're not interested, you're not even taking the trade. If it forms a trigger, which you've got a library of those ready in that zone, then you can take it. And the power of that, of course, is that you've got a fixed stop that you can use with the trigger, and you're in a level that you've already earmarked as a potential mean reversion candidate. All right, guys, thanks for the question. Any comments, comment section below. If you like this kind of stuff, thumbs up is, of course, appreciated. Take care. Bye-bye for now.